Are these the 11 best low-risk investments for 2025? Welcome to Retirement Revealed. I'm your host, Jeremy Keil, and we're here to turn your retirement savings into retirement income. Today, we're talking about low-risk investments, or at least low-risk investments according to an article I found on Investopedia. And the number one low-risk investment, they said, I'm not sure it should even be on that list. So we are going to talk about that today and what you should be looking for within low-risk type of investments. And before we talk about low-risk investments, I think we ought to talk about investing in general. And I think the number one rule with investing is to determine when are you going to need the money. It's not about the risk up and down. It's not about the returns that you're expecting. It's about when do you need the money. I think that's the number one thing to think of. And generally speaking, I suggest you look at the idea of short-term money and long-term money. Short-term money is money you need perhaps next week, next month, next year. I was on Facebook. I saw somebody, part of a Facebook group for another podcast. And they said, I need to, I need to put money down on a house 1 month from now. What's the best investment I should put that money for 30 days? 30 days seems like a short-term time horizon. And thankfully, the vast majority of the comments were saying, you got to look at short-term investments. 30 days is short-term investments. So number one is, when do you need the money? If it's short-term, look for short-term investments. If it's long-term, look for long-term investments, which are generally more towards the idea of growth type investments. And of course, growth on the upside generally isn't possible without growth on the downside when it comes to the long-term, which is probably why Investopedia gets a lot of clicks. I bet they get a lot of clicks on this article saying, what are the low-risk investments you got to be looking at in 2025? There's 11 they put out there to consider. I'm going to talk about all of them, starting with what they listed as number one. And it's not that they even put this in order. They put a number one next to it. And that part, when it comes to the term of low risk, I disagree. So number one low risk investment for 2025, according to Investopedia, is preferred stock. Now, preferred stock is a type of stock that right there suggests it's maybe not low risk. And I'm thinking back to the idea, what's a preferred stock anyways? Preferred stock is kind of like a stock bond hybrid. It's generally doesn't, the theory at least, is it doesn't go nearly as up and down as much as stock, common stock, regular stock, because they offer what's called a fixed dividend. They call that perhaps a coupon. And that coupon is higher than most, when it starts, is higher than the dividend of regular stocks. So that's why it feels like it's maybe lower risk. It's perhaps more conservative in that you have a higher amount of money that's coming out to you. And I like the idea of looking at different types of investments. Perhaps preferred stock is part of your portfolio, but I'm just looking at recent history. And of course, past history does not predict the future. But back in 2022, recent history, back in 2022, the stock market dropped, preferred stocks dropped, the S&P 500, a lot of the preferred stocks are issued by companies that are within the S&P 500. I looked at index fund, IVV is the ticker symbol, is one I use. There's plenty out there, but I use it. IVV as the ticker symbol I looked at. For the S&P 500 in 2022 was down 18.1% for the entire year 2022. Preferred stocks, the stocks that are the number one low risk investment according to Investopedia, was down 18.3% in 2022. I got a feeling if you're looking for low risk type of investments, having a 12-month period, the entire year of 2022, where the preferred stocks, allegedly low risk, dropped even slightly more than the S&P 500. Not sure if that totally qualifies. Even though they put that as number one, they do have a chart in there showing the difference between safety, liquidity, and upside potential, which I think is a good way to look at it. I had somebody on the podcast recently. I think it was Mike Decker. He basically said safety, liquidity, and growth. Those are three things. You get to pick two. Like which two do you want to focus on? And in the chart, Investopedia says that preferred stocks are moderate safety, moderate liquidity, moderate to high upside potential. Not sure how moderate, and moderate to high make it in the world of low risk, but they put that on there. So I want to talk about that. It's worth looking at. I was talking to somebody recently. They told me they were invested in a low risk investment, just like a CD, but you get a little bit more. You get 25% a year. Could I do better than 25% for something that's like a CD? You hear things like that, and you want to make sure you're matching up the expectations with reality. 25% in terms of a return is definitely not low risk. And Investopedia here, I think they stretched a little bit by putting preferred stocks where they used moderate for safety liquidity and moderate to high for upside potential, but then they put it as number one on the low risk investment. Although it brings up a point I say to people all the time, in that the answer to your investing question is not always, almost never, what's the one thing I should do, but it's what are the many things I ought to do, and perhaps that's part of your investment portfolio. Number two, they put for low risk is high yield savings. High yield savings, very similar to money market accounts at your bank. And in the banking world, savings accounts and money markets are virtually interchangeable. That's the banking world. We'll talk about this differently in just a second with something called money market fund. But typically the difference with a high yield savings compared to your regular savings is that they are online. Often you want to go online. What's interesting, I talk to some people all the time and they say, well, I don't trust those online banks. I like my local bank. Then I ask them about their local bank experience. They say, oh, it's great. I just have this app. I go online and take care of it through my local bank. And so the online, your local bank's is an online bank as well too. I'll look it up here, the differences. So why you ought to be looking at online savings, the high yield savings. So let's see here, average savings account. Here we go. According to the Federal Reserve, the average savings account, this was they last took the data in middle of May, 0.42% was the average savings account rate. And I'm looking at depositaccounts.com. 4.23 is the average of the top 1% of savings accounts that are out there. So 10 times higher to go for a high yield savings account compared to the average bank account. So worth looking into. Not necessarily even saying that you invest into high yield savings. It's whatever savings that you have. Perhaps you ought to look at high yield savings and get, on average, it's looking like here 10 times the extra interest. These online savings accounts, they are FDIC insured, no different than your local bank. They just have their main marketing through online purposes. You go to the website instead of the local branch. Now, number three for Investopedia is money market funds. Now, money market funds are different than money market investments at the bank. They are through mutual fund companies, basically, which is somewhat nice because you might have mutual funds in general, and that company that you have your mutual funds with ought to have a money market available, or within your 401k, you ought to have money markets available. These money market funds often pay a similar interest rate to the high yield savings type of accounts. The difference is that they're not FDIC insured, although they have similar interest rates. So that's something where if you have an IRA, it's hard to find a bank IRA. If you got your IRA through a brokerage account and you want to have some savings type investments there, usually it's the money market fund that you'll be looking at in the brokerage account on there. So number four, CD, certificates of deposits. And here's where a lot of people I talk to have a lot of familiarity with certificates of deposits. One thing I find quite interesting when it comes to CDs is a lot of people right now, at least, we're summer 2025, they often look for, well, I'm not going to say right now, it's all the time. You often look for the highest rate and you go into that and they buy the highest rate irregardless of the length of time. If you need money a year from now or 2 years from now, and the rates are slightly lower, let's just say a 2-year rate might get you 3.9, but a 1-year rate might get you 4.1. I'm just making those up right now. You might invest into the higher rate and have it due within a year, even though you needed the money 2 years from now, and you're thinking I'm doing the higher rate, I'm getting a better deal. Well, the whole reason why it's a higher rate now, and then you're a lower rate for the 2-year level, is they're expecting a year from now, when this amount renews, the expectation is that the rates will be lower at that time, which brings us back to our main goal of investing, main question to ask yourself with investing. And it's true for even your CDs, is when do I need the money? I would focus on when do I need to return my money as opposed to the interest rate that are out there. Number 5, low risk investment according to Investopedia is the Treasuries, Treasury bills. And where it comes in is that they're low risk, not FDIC insured, but it's backed by the US government. Also, what Investopedia said is that they're highly liquid. I like a lot with the Treasuries, the idea that within your brokerage account, especially your IRA, if you are wanting money coming due at a certain amount of time, you can actually buy Treasury bills through your brokerage account. You can buy CDs through your brokerage account. I keep an eye on the interest rates. It's worth to see is one paying higher than the other. But what I've found is that if you happen to hold a Treasury and you want to get out of it, there's no penalty, but no one's going to buy your Treasury from you unless they make a little bit extra on it. But perhaps you have like a 4% Treasury that's out there. It might be giving up like 0.05 or 0.1. It's a small kind of difference when you're cashing in. You're basically not cashing in, you're selling it to somebody else early. With a CD you have through your brokerage account, I've seen perhaps even like 0.5, 0.8. You're giving up a larger amount of the interest. You're going to have to offer a bigger discount to sell a CD within your IRA compared to selling a Treasury. Makes sense. There's billions and trillions of Treasuries that are out there. There's a small market for your one particular CD coming due. And if it's a smaller market, that means when you are selling, there's a bigger discount that you've got to really offer for somebody else to buy that from you. Now, number 6, Investopedia's lowest investments for 2025 is TIPS, Treasury inflation protected securities. Those are interesting in the world of low risk. The positive of the TIPS is the inflation protection. Really, you can't get that much from anywhere else besides Social Security. I often encourage people to think of Social Security as an inflation protected instrument because you get extra Social Security when inflation goes up, but you can't just go buy more of it with Social Security. They have here safety for TIPS is in the world of high, according to Investopedia. Liquidity is in the world of high. Upside potential in the world of low. I would agree with most of that besides safety being on the high side. And what's interesting on the high side, you can buy TIPS, Treasury inflation protected securities, and resell them just like you can Treasury bonds. But a lot of these TIPS are more on the long-term area. They even recommended a ETF. TIPS is the ETF that they pointed to. Let me look it up here. The TIPS bond ETF. So it's got a well-diversified. That's good. Well-diversified in all these different issue dates of when these TIPS come due. Calendar year 2022 dropped 12% in 2022. And so that's an area, went up by 10% in 2020. There's a lot of inflation in 2020. But 2022, the TIPS ETF fund that I reference Kipler quite often, so I must have been on my mind, but Investopedia, that fund itself dropped by 12%. So even though they've got this ability to sell, even though you got this ability to have inflation protection, remember when you're buying a Treasury inflation protected security, if you sell early, and of course in the meantime, even if you don't sell, the value fluctuates up and down every day. We saw a 12% drop through 2022 in the TIPS funds. 7 and 8 that they have listed for low-risk investments, AAA bonds and bond funds, somewhat similar to TIPS, except those most often AAA bond funds ought to have some government funds, but often have corporate bonds, big companies that you've likely heard of before. It's a promise from the company. It's not backed by the government, unless it's government AAA fund bond, but it's backed by that particular government. It might not be the U.S. government since they're getting some bond ratings changed around there. But a lot of people, they say, oh, I'm going to buy bonds because you're guaranteed to get the money back. Yes, you're guaranteed to get the money back by the person guaranteeing it to you unless they are not around. AAA bonds even can default. There can be times that perhaps they don't pay the money back to you, which is why number 8, Investopedia recommends, or I'm not going to say they recommend, they encourage you to look at. Here's 11 different areas to look at as low risk investments according to Investopedia. Bond funds. Now, I get into a lot of debate sometimes with bond funds with people. And the theory is, here's why people don't like bond funds. They say, well, a bond fund, that just fluctuates in value all the time. I'm going to buy a bond because I buy it today, and when it comes due, I get my money back. Yes, true. And what happens in the meantime? It fluctuates up and down, no different than a bond fund. If anything, a bond fund perhaps fluctuates less than an individual bond because there's hundreds of bonds, individual bonds inside of the bond fund. I've got a certain bone to pick, I'd say, where a lot of people feel as if an individual bond has no risk, but a bond fund has risk inside of it. A bond fund is just a collection of individual bonds. How can a collection of the things you are telling me have no risk be riskier than just the individual security, the individual bond there? So I guess let me know your thoughts. You can comment or email me, podcast@KeilFP. I'd love to hear your thoughts on buying individual funds, individual bonds rather, against buying a bond fund. And here's the thing to keep in mind with tips that we just talked about, AAA bonds, individual bonds, and even bond funds, is that there's still risk there. And a lot of the risk has to do on how long until this bond comes due. So back to the number one thing you ought to think of with investing is, when do you expect to get your money back? If you have a bond fund, you can buy short-term bonds, a short-term bond fund. If you don't need the money for a few years, you may want to buy a medium-term bond fund. You're going to look at something called duration. That's telling you, on average, they do a bunch of math to get there, but on average, when are all the bonds inside this fund coming due out to you? And so look at your bonds and look for the thing called duration. I have not seen too many people looking into duration, which is something you want to look at. Municipal bonds, number 9, what is Investopedia talking about for low risk funds for 2025? Municipal bonds, very similar to individual bonds. I mean, they are individual bonds. They're just backed by a government that's not the U.S. government. And why that's helpful is there was a Supreme Court ruling years back that the U.S. government can't tax then the interest paid out by municipal bonds. So people talk about being tax-free municipal bonds, which is helpful if you're in a higher tax bracket. But remember, that's tax-free for the federal government. You still might have some state, local government taxes that are on there. And these are individual bonds. So they've got the default risk that an individual bond might have. So perhaps you would look at a municipal bond fund if you're interested in that as well. And this is municipal bonds. It's not the U.S. government. They can't just create money out of the thin air from the Federal Reserve, right? They can't just tax everybody the way that the U.S. government perhaps could do that. So municipal bonds, hopefully, ought to be paying a higher interest because there's a little bit more risk there. They don't have the same types of abilities to pay back their bonds the way that the federal government would. Now, they finished 10, 11. I don't know if they did this. I don't think they did this alphabetically at all or rank ordering it. I put the numbers on there, so maybe it was ranked ordered. But number 10, they talk about annuities and cash value life insurance. I'm going to talk about those together because they're very similar. They're both offered by insurance companies. And when you hear about an annuity, you might have a lot of emotion around that word. The annuity that they're talking about is something more like a multi-year guaranteed annuity is the type of annuity that you're often looking at, where it's virtually a alternative to CDs. The difference is that it's not backed by the FDIC, but often the insurance company then is backed by a state life insurance guarantee association. So you want to look into that as well. You want to see how viable is this insurance company, just like you would evaluate a bond. You want to look at the state life guarantee association rules, just like you want to look at the FDIC rules and coverages on there. But the multi-year guarantee annuity, what I've seen the last several years, and there's been some research by David Blanchett, who's mentioned this. He's been on the podcast a few times, where often these multi-year guarantee annuities pay a higher return than the CDs. They pay a higher return. This is not all the time, but that's what the research has been showing, is on average, they pay a higher return than similar bonds that may become due at that time. The big difference, and this is where Investopedia really shows it, that this is minimal liquidity, is what they call the ability for you to cash in your multi-guarantee annuity is much different than a CD or perhaps a bond. So you want to very much look into what are the rules around when can I get my money back. This is the theme of the day here, is when you invest, number one question you ask is when and how do I get my money back? And then what's the risk up and down along the way to get there? Cash value life insurance, somewhat similar to annuities, and that it's backed by the insurance company. The insurance company has a general account. So in my mind and in my experience, I'd say the return of a annuity, a fixed annuity, and the return of cash value life insurance is quite similar because it's backed by the same thing. It's backed by the claims paying ability of the insurance company. The big difference is that it's life insurance, cash value life insurance, where if it pays out to your beneficiaries, it's tax-free to them, but that's got to come from somewhere. It'll pay out a higher amount than what you put into it because you've got insurance on there, and that means there's a cost to it. So right now, when you look at the comparisons of all of them, it's not even just about when do you get the money back. It's not even just about when do you, what's the return on those. Theoretically, if something's all similar risk, the returns ought to be somewhat similar on there. But the tax benefits are something to keep in mind. Maybe that's why they put number 9, 10, and 11. Municipal bonds have the tax benefits that it's federally tax-free. Annuities have the tax benefits that you can defer your taxes on the interest that you've earned until later on when you take the money out. And cash value life insurance, same thing. You can defer the taxes on the interest until later on when you take the money out. And if it comes out to you, it is going to be, comes out not to you, but to your beneficiaries, that's going to be tax-free. So what I do like about this article is that it gives you a whole lot of different options. And it encourages you to look at all the different options. And they've got a chart on the safety, what are the ups and downs of an investment, the liquidity, how can you get the money out from it, and what's the upside, what's the likely return in the long run. Those are the things you ought to be looking at when you're looking at low risk investments, any investment. And keep in mind, the number one rule when it comes to investing is first think of, when do I need my money back? I'll put the link to this article in the show notes. I appreciate you listening. Thank you for listening to the Retirement Revealed podcast. We believe if you know more about your money, you will feel better about your money and you will make better money decisions. Hi, I'm Jeremy Keil. If you'd like to learn how my team can help you get more income, pay less in taxes, and avoid big retirement mistakes, head on over to keilfp.com. That's KEILFP.com.